Yes, describe me like your podcast.
Yeah.
Can you say the name?
No.
Not afraid of losing our jobs. I think there are maybe some of the analyst or research elements of the jobs that should become much easier. Like that's the best thing about private equity is just take other people's ideas and you can implement them better, and then you actually have a good business. We try to build businesses that have a sustainable competitive advantage and high market share.
So when you say adding value, what would that really look like?
I mean, no one wants to say they distract value.
No.
There were a couple of years where I said we're only going to interview women before we interview anyone else. You're either going to pull on it and it's going to keep coming and you're going to climb up, or you're going to strangle yourself. It's going to take too long when we are trying to buy a business, $1 billion business in a month.
Is that how quick it is?
Can be, yeah.
Welcome, ladies and gentlemen. You know the drill. It's another episode of the podcast. With me, we have Josh. Josh, it's normally this time I sort of make a quick jibe about how your sports career was less impressive than mine, or your pretty boy image, but you've recently had some good news where you're moderating a venture capital panel.
Yeah, London Venture Capital Summit. It's going to be exciting. So, moderating the health tech panel on the 15th of June. So there's still some tickets out there. So grab yours while you still can.
Right. Congratulations.
Thank you.
I don't often be nice to you, but this is you've worked hard.
Exciting times. So yeah.
But now on to the star of the show, the one that we really care about. It's great to be here with you, Matt. Obviously, this room is giving Stephen Bartlett a run for his money. Thank you so much for having us.
Thank you. If I can see Josh get his hair done.
Yeah.
It's always a pleasure.
But yeah, Matt, today we really want to sort of go through, your career history, the investment strategy and outlook of Francisco Partners, and sort of, as ever, we try and give some advice to the next generation or things that we wish we knew on our journey that maybe would have saved us one or two missteps. Well, do you want to start with like a walkthrough of your sort of journey to be, partner at one of the sort of most recognized firms globally?
Definitely wasn't the most recognized when I joined, but my journey. So I grew up in the Appalachian Mountains of Virginia, in a small town there. My father was from Germany, and my mother was supposedly in the oil business, which meant they owned a gas station, the only one in the small town in Illinois. But I actually grew up wanting to be an automotive engineer. I actually went to school to build cars and race them at Georgia Tech. I started an organization there called GT Off-Road, and spent most of my time actually at school in the machine shop, building off-road vehicles, kind of racing them. And I really actually enjoyed that, just kind of being hands-on, real engineering. But I also enjoyed the business side. We had to go raise like $45,000, which was a lot of money at that time, to kind of build the car and, go to different races. And so I started having to go pitch, try to raise money. And, in doing so, kind of learned a bit more about the business world. And I started my first company actually there, as I didn't have a lot of money in a machine shop. So I created some wine racks and furniture with some friends, and we started to make them. People liked them. We gave them as gifts. And then we started being on trendsetter.com apparently. And we hired a couple of people to produce them, and it was fun. I'd say today they're still just gifts for free, but I had to find a real job, let's say, after I graduated. But it all kind of gave me a taste of, kind of learning business a little bit. And so after that, I decided to go into consulting, and went to Bain & Company on the strategy consulting route. And I also didn't have much of a clue what that was, but thought it was a great boot camp in business. And it was. And I would say, my meandering was not as purposeful as probably anyone listening to this, because I had no idea what finance was. I had no idea what private equity was at the time, but it was through the consulting projects that I found out what private equity was.
Yeah.
And most of our clients were actually private equity customers, and I saw that their job was a lot cooler than my job, making PowerPoint slides all the time. They actually got to read them. It's very true. My job didn't change for a number of years. And then I learned one thing in consulting, which was, you need a sustainable competitive advantage to win long term. Like, and I looked at private equity with that maybe naive lens and said, where are there sustainable competitive advantages in investing? And, for me, that was kind of one of two things. It was either an industry or a sector expertise where you can get to know the industry better than others. You have differential access by way of knowing networks, or you have differential insights because you actually, know things ahead of time, or you can stay ahead of the game. And for me, that industry was kind of tech. I love technology. I did an engineering background. I had also done some internet startups. And so that was a goal. At the time, there was only two tech firms. I think it was FP and Silver Lake. And Silver Lake wasn't hiring. This is in 2003.
Okay.
And I found out FP was supposedly hiring, and I, tried to get an interview. Originally was kind of rejected, but then got my foot eventually in the door. And I had to interview at the time with every single person at the firm, which was like 20 people. I had to go through like brain teasers from some guy that graduated Stanford at age like 16.
I remember you telling me the process.
It was quite a jarring process, but apparently they had hired a consultant once before, and he made a modeling mistake that cost a lot of money. Lo and behold, I got lucky, is the long story short, and got a job at FP in 2004. So it'll be almost 20 years and a month or two since I joined.
Can I just say, I really appreciate you saying doing 20 interviews and getting it was lucky. That sounds like quite hard craft.
Yeah, it is. But I mean, it's part of the advice. Like, I had no idea what finance was. I didn't have a single finance class at Georgia Tech. I was all engineering. I found one friend that actually knew about something in finance at Bain and kind of said, teach me what you know. I bought a book about private equity and read it. And then, I just had to practice. I suggest I practice interviewing. When I thought I did okay. I graduated, high in my class, and I thought I was smart, but it doesn't matter if you're smart. This is like a learned skill set, interviewing, and especially case studies or going through things. And so my advice is that it's not something you can show up no matter how smart you are. It's actually the hard work that matters and helps get you there. And so for me, I actually failed my first strategy consulting case study at BCG because I froze on the numbers. I'm really analytical.
Yeah.
But I just couldn't do the math. And, it was only after I practiced a ton of times so that it became more second nature. I could, get through. And luckily then the second time around, I got a job, at Bain that started that, flywheel. So there's no shortcuts would be my answer, even if it's your own domain expertise.
And then leading you to...
Yeah, so at FP, how did I actually survive?
Yeah. Well, you did your MBA at Stanford? I
did. So I did, our typical program associate is a 2 or 3 year program. And then, you would go to business school or you would potentially be promoted through. And for me, I've always had a internal struggle of, do I want to be an investor or do I want to be an entrepreneur? I never grew up saying I wanted to be an investor. I actually, more often thought I'd start a company or do it. And one of the things I did my second year at FP is I actually came out to Europe when we were opening our office, and was stupid enough to raise my hand and say, I'll go. And I was just in the back office, ordering stationery. It was just me and one other guy. But it was a lot of fun. And frankly, we made a lot of mistakes. We actually screwed up a lot of things. And the good news is that gave me good fodder for my business school applications of what I don't want to emulate or do. That also kind of seeded a bit of the idea of you're, starting something in a new office and a new area. And so when I went to business school, I decided to do that. And I would encourage people, if they're going to go to business school, go for a reason. It's 2 years. It's a lot of money.
Yeah.
A lot of people go because they're cool and they have money, and you could make up for your college years when you studied too hard and weren't cool. But at least for me, that journey was about deciding if I wanted to be an entrepreneur or an investor. And I knew the investor world a bit, And so I spent all my time kind of doing entrepreneurial things. I ended up starting like 3 companies and took all the classes in the engineering school or the design school or the law school, not really on the business side. And that was really rewarding and at least led me to try to find what was my interest, and that was being, I guess, I have too much ADHD tendencies for focusing on one thing. And so I liked the idea of the investing because it's a privileged position where you can work with many companies. I sit on 6 boards today, and I probably met like 5 companies today and entrepreneurs, and that's really cool, privileged thing to do.
But they're not small companies either.
No, they're at least in our world. They're not these days.
Yeah.
They were much smaller when I joined. And then, long story short, I decided to come back to business school to Europe.
Okay.
Was supposed to be 1 year to kind of fix a lot of the things that we had done wrong, where we tell our companies not to do. We made our mistakes ourselves in expanding our first office. I left my car in the parking garage in San Francisco at the office, and lo and behold, I've been here now 15 years.
And the car's still there.
The car lasted about 5 years, and I lost a lot of friends on that, asking them, "Can you move my car again this month?" That was fun the first thing a couple of times, but eventually that's I've been here, was been a partner now for, I guess, the last probably 10 years, and been co-head of the office in Europe, and then kind of had different themes over the last number of years, where I can think music has been the space that spent the most time over the last 5 years or so.
Music's an interesting space because that's the sort of royalty thing has come about recently. So has there been a bit of disruption in the music space?
The music space is screwed up. I think, to put it mildly. Is there disruption? Yes. There have been many, I'd say, waves of disruption in music. The biggest one was, there was the old school records that then went to CDs, that then went to, well, I guess tapes was in between, and then went to MP3s, and music effectively fell off a cliff with Napster and the idea that you used to buy an album for $20, and now you can buy just the song you want for 99 cents. And then Napster gave it to you for free, which didn't help. And then, the advent of really Spotify and streaming provided a new foundation to music. And so it was just a couple of years ago, the music industry got back to where it was, I guess back in 2005. So it took almost 20 years to get back to the same revenue levels of where it was. And if you even look today, the average amount spent on music for an individual is less than it was 20 years ago, 30 years ago. But what's very different is that every time you play a song now, the royalties are paid to that artist, whereas before they only got it when you bought that CD, and all the revenues are recurring.
Yep.
So now every new person is paying each year and adding up and up. So there's a stability and a growth tailwind there that had never been in the music industry, because it used to be boom or bust, boom or bust. And so I think that advent has created a whole new investing ecosystem, because now people will look at it and say a song is an asset. Okay. So, if you have a favorite song, you listen to it, 100 times, and everybody does that. Now you have a very predictable revenue stream of it, and people will say that's a financial asset, actually, and they're even securitizing it and turning the whole wave of investments around it.
And to tie this in, we met some guys called Sam and Leo from Chiron Sports, who were talking about celebrities getting better at managing their image. And another sort of tidbit I found out recently was that David Bowie released a Bowie bond. Don't know if you know. Do you know about this? I'm going to probably butcher explaining what he did, but he sort of sold the rights to his music to investors in like a bond-like structure to fund something, and then basically repaid them back. It was really successful. So I suppose in some sense, the space has always been evolving.
Yeah, no, the Bowie bond was a great trade for him because it came back to him. But there's a whole birth of a new industry around music investing. And I just started about 700 million JV with one of our companies, Cobalt, to start maybe buying the Bowie's proteges, compositions and copyrights and stuff. And it's a fascinating space that's definitely kind of changing.
Can you tell us more about that JV, or is that?
It's public. I think one of my investments recently has been in a business called Cobalt, which is one of the largest independent music publishers. So what does that mean? Songs and music. I don't know if this is interesting to explain, but a song is made up, or any music royalties are made up of two pieces. There's the master or the recording, which you can think of as the audio file that's recorded when they play. And then there's a composition, essentially the song that was written, which has a copyright to it. And each of those are actually monetized separately. So recording labels collect the recording side, or what's called the master line. And the copyright is, or what's paid for publishing of the copyright, is collected very differently. And often a popular song will have 5 or 6 different songwriters. And the people that performed it often are very different than the people that wrote it.
Yeah.
And it's a very complex ecosystem, because then you take those 5 or 6 songwriters, end up signing with different publishers. They all learn different songs. And what makes it even more complex is if you play in Germany, it goes to an organization like GEMA, who is a local German collection organization that then pays it to a U.S. organization that then pays it to you. And the collection for something sold physically is very different than anything digitally. And bottom line, it's a cluster that is really hard to kind of collect and map. And so the role of a publisher like Cobalt is to essentially collect the money for all those songwriters.
Okay.
And as part of that, we have very good data, and we collect maybe 10 to 15% of the market. And then we have an opportunity for artists, seem to always sometimes want extra money to fund new projects or other things. And we got the ability to invest in those. And so you could say, just like David Bowie did, I could invest in buy your songs for the next, it could be 10, 15 years, or it could be in perpetuity. And so that JV essentially was set up that Cobalt has all the deal flow, again, competitive advantage or differential access. And we have all the data on how it works. So they have a very well-trodden way to value these copyrights.
Okay.
And then what we do is buy a bunch of little ones. We'll buy it for 5 million, 10 million, 20 million. We put them into we just did one for 400 or 500 million. And now that acts like a bond. It's actually very predictable, because you buy songs that are 5 years old or longer.
Yep.
So they've already gone through the hype cycle. And then we took that bond and did an asset-backed securitization. So you essentially turned it in, or those copyrights, you turned it into essentially a bond, or something like a high-grade CLOs, they would call them, or otherwise in other worlds. And now insurance companies will buy that, because it's a very predictable stream of revenues that's hopefully growing as more people listen to music and Spotify grows. And it's not correlated to the economy, because whether you're feeling good or bad, you usually listen to different music, but you still listen to music.
Yeah.
So that's a long-winded answer, but it's a little bit of kind of at least that small bit that we're doing.
No, that's very interesting. And it dusted off a few of the terms from my CFA that I remember. The diversification and uncorrelation.
Yes.
Yes, no, that is interesting. And I'm trying to think through this in sort of real time, but obviously with a normal private equity transaction, you'd obviously be expected to add some value in some way through a restructure or new management team, whatever that is. Do you do anything like that with the music catalogue? Do you market it? Do you have a distribution channel to try and increase the plays, or is it just about bringing the assets together and also just like you say, having better information and a model to buy the ones that are mispriced, perhaps?
It's a good question. So I'd say first thing I'll say is a JV to buy music copyrights is not a traditional private equity deal, and in many ways it's one of the kind of levers of creating value that we had with Cobalt, which is really the platform there.
Okay.
And we are, I'd say, adding value to that by creating the JV, because it didn't exist there before. It's a way that, as Cobalt, they get to acquire more things in their ecosystem. And there is an unfair advantage in that what we buy, cobalt, at least in my opinion, is one of the best at monetizing them. So then they can go out and they can sell them into commercials. They can, help collect the revenues to be higher for those copyrights, and we do add value in that way. But I'd say, at least in that niche, it's not as traditional as what private equity usually does, is buy, operating assets or companies, and then our goal is to improve them over, usually a 4 or 5 year time frame, and then find a way to monetize it through, another private equity firm, a strategic, or potentially going public and turning into public equities.
We throw around the term adding value a lot, but I think every industry vertical in finance has different explanations for adding value. And I think from a PE side, what exactly is that to you? So when you say adding value, I mean, what would that really look like?
I mean, no one wants to say they distract value.
No. No, but I'm saying
invest with me. I'll help you lose value. It's great.
But I just mean, everyone sort of says they add value, but really from your lens, how is that at FP?
Yeah, I think so. From FP, our recipe has kind of been 3 things since the very beginning. The first is focus. So we focus only on technology businesses, and 25 years ago that was really unique. There was only 1 or 2 firms doing that. I'd say 2 is the size and stage. So we don't do startups. And we do only really help businesses that are at a point of already proven product market fit, scale, and what we are good at is helping them, get to the next level, if you call that. And then the third piece is usually those businesses or outcomes, we want to have some sort of transformation over our ownership period. And that can take a lot of different ultimate shapes or forms, but that we want a business in 4 or 5 years to be fundamentally different than what we invested in. And, how do we do that? I think it's by bringing the resources, the focus, and like the capabilities to just do it. And it sounds simple, but it's actually hard to do. So like we've built a whole organization we call FPC or FP Consulting, who are, I guess now it's 40 or 50 senior executives. Their whole job is to help our companies not make the same mistakes. Because when you get to the point of focus, we've invested in 200 to 300 software businesses at this point. We've made lots of mistakes with those. A lot of them are founder-owned businesses. Sometimes they're divisional carve-outs that don't have a management team with it. Sometimes we're doing M&A, but our job is to help those management teams have the resources to effectively have an unfair advantage. And those resources are, one, yes, just capital, but everybody's capital is the same color depending on what country you're in. But it's really what I see is like almost everything is the same movie with just a slightly different script and setting.
Okay.
And when you get that pattern recognition, when you can point to and say, hey, you're doing a cloud transition, you're moving your software over. We've done this 14 times. Let me bring in our CTO from FPC. He's going to sit there and help you do it. And, we actually have pricing with Amazon that's for all 50 companies scale, which is many billions, but we're going to give it to you, a small company with, 50 million in revenue. And that's an example of adding value. Or I brought 3 businesses together. None of them had a CIO. We need the infrastructure to be set up. We put in a guy to be interim CIO. He put in all the infrastructure in place, hire the person behind him, and it just allows you to move faster and kind of execute better than they could on themselves.
It's interesting. I think we see that differently from early stage venture versus it sounds a lot more complex from what we do, but very interesting.
Yeah. And it's sometimes bringing relationships that they couldn't get on their own.
Yeah.
Right.
I think that's how we see our value add a lot at Q Ventures is the network. But I didn't know about the consulting arm with FPC.
I think we've been, lucky the last, 15 years to be in tech. It's a great place to be.
You're a very lucky guy by the sounds of it,
I am. That was my wedding speech. It was actually about lucky. And I had one CEO once, I was talking to him about interviewing people. Yeah. So a lot of my job today is interviewing executives or otherwise. And he said he would end each interview with a question that was just, are you lucky? and just pause. And you get some pretty interesting answers where people go. And it's probably the most personal question I guess you're allowed to ask, maybe with HR and the like. But
must be some wild anecdotes there.
Yeah, there's one time in Amsterdam, the police were closing in, and
What's your favorite closing interview question? I mean, it might be a secret.
I stole the same one. That's the best thing about private
Okay.
equity is just take other people's ideas and you can implement them better, and then you actually have a good business. But like on the added value, I think I'm proud. Like we've had, I think, some of the top performance anecdotally from looking at, not anecdotally, but scientifically from looking at some external studies. And I think it is that actual value add. It's the ability to, most of the business I've invested in are founder run, right? So by definition, the first time they've gotten to 50 million in revenue, 100 million in revenue, and the problems that they face, they just never have somebody to actually talk to.
Yeah.
And then, the effort we put in is also very different than venture capital.
It's amazing.
Right. So we don't I'll invest in one company a year, and, we put a lot of effort into that and try to help it with M&A, try to help it with, recruiting people that they can never get there because we have a track record of creating value that they'll end up joining. Like one of my businesses, we did a, OEM agreement with Salesforce.com, and that they never could have done themselves, but I knew the head of the division, like they wanted the product, they just couldn't work with the current kind of team or CEO. And we, checked with SAP, who is also the big competitor, got them to re-up a big OEM deal that they just canceled. And if you fast forward 3 years, that deal with Salesforce ended up becoming 100 million, and they bought the business for, almost $1.5 billion.
Wow.
And it's
That's
like,
cool.
that would not have happened if we had not been there and done the hard work, already had the relationships with those strategics. And that's what also gave us the confidence to invest, because, I knew that, we had some big people and ecosystem around us that, already wanted the technology.
So if you're looking to sell a business, I think FP might be a good shout.
trying to build a business.
Let's start somewhere.
Yes.
Yeah, actually, what would that? If anyone wants to sponsor the podcast,
That'd be great.
I'd imagine what you've described loosely is the culture, right? How difficult, as you've sort of grown in your career, have you found cultivating that culture where, you're encouraging people to get these like Rolodexes, or, be able to like put in long hours, or just generally like help to add that value? That must be a firm culture.
Yeah, no, it's a good point. And actually, right before this, I was talking with a lady as the president of one of our businesses, and we just put her through our first like future leaders training, and we were actually talking about culture at her company and how we wanted to, it's an important thing that we're teaching how to drive, and we're trying to get it to be frankly more of a focus and a stronger point as. Oftentimes when there's founder transitions or people management changes, the culture can kind of change. But, I think her point and takeaway from that was the FP culture she thought was very unique. And, if having worked at one company for 20 years, I guess I do have the benefit of seeing a lot of others, but I do think it's probably the one thing that makes FP, not the one, but one of the strongest points that we have. Is that our culture is very inbred, and it's how is that defined? It's if you look at the partners that are there, I think almost all of them, bar one or two, started at the bottom and kind of worked their way up as associate or VP, and that's good in many ways. That the culture is very instilled, and we have that kind of culture of bringing people up with us. In some ways, it's bad because you're maybe not getting the diversity of thought or viewpoint, but for us it's all around kind of being meritocratic. It's kind of not, it's getting stuff done and doing it is there, like doing things with integrity, being humble. We have an industry that is very privileged to be where it is, and we have to remind ourselves we're spending other people's money and a bunch, and it's not our billions. And we do it on behalf of millions of retirees and pension funds and others, and some people in our industry forget that. And, I think FP has always had the people there in many ways have always had a chip on their shoulder or something to kind of prove. And I think that's what made the company, everybody works extra hard, but, also is, striving to be, the best.
And just in terms of, because you said that people, tend to rise up the ranks or at least have the opportunity to rise up the ranks to partner. For our viewers who are associates or vice presidents in an investment bank, what's the best way to sort of lateral into a place like FP?
Yeah, I'd say it's a good question. It's hard. I'm not going to lie. Because, I think, and even from our perspective, like the recruiting is ridiculous, especially in the US where we hire people, almost with like 6 months work experience to start 2 years ahead. Essentially the US recruiting industry kind of became very competitive. And so each firm started incrementally trying to go before the other firms, like a month ahead of time to get the best people.
It's like college sports recruiting, when they pick them at 13, 14 for the big top schools.
Yes. It's like probably not my son on the football team to getting scouted early, but no, I think what is the advice? So I think everyone that is applying, you have to assume, at least to get through, is going to be qualified. And what does qualified mean? There's probably a level of, you look for intelligence because we process information, do things very quickly. So that's, at least seen usually with test scores or grades. But you need to have something else that kind of can help you stand out. And I often would look at in resumes almost a section at the bottom or the interest, or see if there's something there. I did like to see success in sports is often helpful, or initiative. Like I really value initiative, and so if you've started something or done something on your own, that shows that you have that ability to work for yourself, at least in an FP culture where it's very entrepreneurial. That's something to look for. And I used to describe it as a rope. Actually, it was described to me as a rope that's hanging there when I joined. And it's like, you're either going to pull on it and it's going to keep coming and you're going to climb up, or you're going to strangle yourself. It's like, thanks a lot. That's a good,
That's great. You're climbing
welcome.
or you're dying.
Anyway, your desk's over there.
Yeah. I think it probably should have been entangled, but I think having that initiative or something that you've done where you've created something yourself, or where you've had a chance to stand out, helps at least. And I would highlight that on a resume. And then it's like, it's going to be, the stars have to align. So don't get disappointed if you get turned down at the first place or the second. Like, you need to find what that right fit is and work through it. I mean, at the end of the day, also, at least in London, there's like only 2 or 3 recruiters that really control the private equity world as well. And so, getting to know them and ingratiating yourself with them probably is a helpful point as well.
Yep.
Just have to be lucky.
And it's true. And look, it's part of it.
Create your own luck, right?
You got to give yourself a platform to be lucky, right?
Yeah.
No one's gonna throw a Hail Mary just like open doors for you.
I would like to ask, as you know, I've got quite a non-traditional background, and how I, my journey, how I got into the finance world and in VC. But
ladies and gentlemen, Josh is currently asking for a job.
Are there ever like non-traditional routes into private equity or at FP that you've seen or you've hired, and if so, what were they and what were the exceptions?
There always are and always should be exceptions. I think we've hired associates from Microsoft a while ago and done kind of the industry route. But I will say, where it's hard, I think FP is very non-traditional in many manners, but most investing, at least smaller firms, don't have infrastructure. So like what we've struggled with is we have a big push on diversity, inclusion, hire more women on the team. I was proud that we had, I think at one point in my team, almost 30% of the women in the office were women. But that was really hard. Like there were a couple of years where I said, only going to interview women before we interview anyone else. And there was, I think, 2 years we actually didn't hire someone, and then had to go back. And like, that's because the bar is very high for, being able to come in and be productive in the job without these systems of support around. So like, what we have struggled is we don't have people to train. Like, we didn't even have an HR person until probably, I guess Grace has been with us maybe 5-10 years now, but like, so it's hard to come into that type of environment and not have enough of the background to be successful. And so the prerequisite is, how do you get that background? And the traditional manners are often taught in consulting, I guess, or investment banking, are seen as the best training ground for that.
Yeah.
And they probably are. What's hard to spot is, what are the alternatives? And the alternatives are, people trying to figure out themselves. And I think, frankly, some of the best people, used to be the best people, would go to investment banking 20 years ago, or consulting, because it paid the most and that was the most prestigious. A lot of tech companies now, or other companies, are actually probably more prestigious. And so we are trying to find ways that we can find that pool and attract out of it. But I don't think we've solved it either.
That's really interesting, because I was actually going to ask, like, as a callback, what's the best boot camp? And you sort of said consultancy or investment banking still. But I suppose, like you say, that there seems to have been a bit of a shift in the last 10 years where tech and, really good software engineers that are just as smart and sophisticated as investment bankers, it's obviously not directly relevant to what you do, but I suppose if someone's really talented from that field, you would probably want them, because they've almost skated to where the puck is going in terms of the new burgeoning industry.
Yeah, so it's a good question. I think there's very different skill sets for very different jobs in finance and investing. And it's almost a spectrum of what you need. Like, in a VC world, it's all about networking, hustling, instinct, meeting people. And frankly, there aren't that many junior jobs, because most of it's learned art and based off of people that have usually been successful and go into it. But the job there is not as analytical, but much more based on kind of getting access and meeting people and networks. There's, the jobs of, I'd say the other end spectrum is kind of what we do in private equity, where the job of the associate is very analytical when it starts. It's like, how do you dissect a business with, could be millions of customers? How do you break that business down into its smallest components? How do you then rebuild that up in a model that we can use to understand the business parameters? And we're going to make our investment decision by, how do we take all the strategies we want to do and the things that could go right and wrong, and run it to that model and look at essentially the risk and reward and price that and say, this is what we're going to pay for the business. So the associate owns that model and has to be very analytical, very proficient with Excel, understand how businesses work, have some degree of accounting understanding, because if we need to explain what revenue is, our balance sheet, or gross profit, like, it's going to take too long when we are trying to buy a business, $1 billion business, in a month.
Is that how quick it is?
Can be, yeah. And so I think so it depends where in the world, and there's jobs on now business development side, there's jobs on back end side, and jobs on debt where it's less person oriented. But for that associate job in private equity, that skill set of how to analyze a business is the one that's most important to start. The irony is, that's not the skill set that makes you successful as a partner. It's the exact opposite, but it's kind of at least a prerequisite to start.
Out of interest, just because you sort of mentioned you've got VC and private equity, we have a few people in the group who are like sell-side analysts or asset management. Where would you put that in the spectrum? Because do you ever hire sell-side analysts? Do you ever look at those?
Sell-side, we've had a couple people coming from that. Sell-side analysts on equity side.
Yeah, just like listed equity research.
Yeah, there's one person on our team that came from that but is more doing business development type role, more non-traditional, I'd say. I think that qualifies. So I'd say it would not disqualify. Like if I'm using the lens, do you know how to break down a business? Do you know how to model it? I think yes. Um, I think that asset management, wealth management is slightly different. It's more, at least my judgment on it is portfolio construction and stock picking more than it is kind of the deep analysis. And look, I think FP is much more on the spectrum of, I'd say, analytical and focused on modeling and breaking down the business than maybe some other firms. And so, to go back to your question of like where does non-traditional work, a lot of the larger business firms and shops are able to have the infrastructure that can support different people. There are now like jobs, we've started to look at maybe experimenting hiring people straight out of college. So maybe we can get the best people that way and not have to, because they're not going to investment banks or elsewhere.
Yeah.
Maybe. We've started a intern program, at least in the US. This is new the last couple of years, where a lot of it was focused around people with not traditional background, kind of saying we'll let them come in from the summer, try. Again, it's focused a lot on around improving diversity, because those people often haven't had the traditional background. And then can we create opportunity? And I'd say it's probably been 50-50 hit rate on it. But so we're trying to evolve, and I think we're a microcosm of the industry, but you can do it.
Can I change pace and touch on the diversity point? Because you shared a recent LinkedIn post, which I thought was quite interesting, from Defiance Capital and TechCrunch. It was a study that found 70% of unicorns were underdog founders. Unicorns used to be male-only founders, but it's changing with 17% having a female founder in 2023, and 53% have degrees from top 10 global universities. So obviously, I think there's a slight trend where the top 10 university is decreasing, was I think the point. But just curious, so when you look at a deal, do those kind of soft characteristics come into it, or is it more on the hiring side where you've got that diversity push?
It's a good question. I would say when looking at a deal, it is relevant but not deterministic on, I'd say, the background of the management team. Now, I have done mostly backing founders, and I think the founders are more relevant. A lot of our teams we back aren't the founding team. They're kind of a hired management team or a team that's been there for 5 years or 10 years, because some of our businesses have been around for 50 years plus. So I think in our world, which is much more buying established businesses, improving them or helping accelerate them, it's less important. The hiring side of it is, because many times what we're evaluating is the business, and sometimes what you can improve is actually the management of it, or how you kind of drive it. On the flip side, on hiring, I think it is important, and I think on team composition, it's very important. So that you can find a team that has that mixture of diversity and experience and in thought and otherwise, I think has empirically led to better outcomes. I think this is an interesting study by Christian, as a friend and guy I backed to start a little bit Defiance. Is his thesis is it's around essentially the people that have the adversity or the chip on the shoulder that actually then kind of create the great outcomes. And I'd say it's less relevant for FP. It's more relevant for the VC world of looking at what he's doing of backing, because at that point you're backing people to figure out the problem. You're not backing what we back is the business effectively to be able to be successful.
I imagine that's what led into the name Defiance Capital.
Yes, better than your name of the podcast.
Yes.
Yeah, we've had some stick for the podcast name, so we're gonna have to go back to the drawing board maybe.
Back to the drawing board. Sadly, we can't afford to hire a consultant for the name change. So, can you take a sabbatical at your? So you're effectively like you've got shadow models and pitch books, kind of like you're waiting, and then you just when you hear the rumor, you get maybe someone picks up the phone, hey, we think something's happening over here, and 24 hours later you see on the news, CEO resigns or firm up for sale or whatever. It's basically you've done all the hard work preparation, and it's just execution in that 3 to 4 week period.
Yes, I'd say that's the goal. Especially with like at FP, all we do is tech, right? And then each partner usually has a focus area. So someone's only doing fintech or education or vertical markets or cybersecurity or stuff, and that's where I spent time in music or media. And in that world, our job is to all know like what are our hearts and minds companies, like what are the 10 companies we want to own. And, if they're owned by another private equity firm or if they're public, like there, is usually an opportunity to invest, or even as a founder, like one of the companies I spent 5 years with the founder, like met him 3 times a year. Are you ready to sell yet? You ready? Like, finally took him to actually hit some bumps in the road to recognize he could use some help and work. And so that's not uncommon. But it's when you get that signal that they're actually willing to transact or something may happen, maybe with a banker, that's when you kind of got to push go. And so it's more about being prepared, and doesn't happen on every deal, but for these days the best companies for something that's $1 billion plus, like we just bought a business this year where it was right after there's first round. Usually there's a first round, a second round, a third round to buy a company. And like the weekend after the first round bid, we signed it. And all the other people were like waiting for feedback on their first round bid and read in the newspapers that the deal is gone. And it was a great business. And we probably paid the same price or less than they may have gotten if everybody had gotten there at the end. But we forced a decision of, are they going to take a certain very good, offer now, or are you going to wait for everything that could happen or not? And you have to play those risks.
Do you ever pull away an offer if they're taking too long, or?
Sure, you have to, or you don't have credibility.
Well, that was yeah.
This sounds like my house situation. Just Josh was threatening to bring this up for ages.
He put in an offer for a house that had a giant crack in the side of it, and he was trying to save it. And anyway, it's a long story.
Yeah. Save the house or the offer, or
just the seller was. I don't know if he was a genius in hindsight. And the agent's like, hey, like, you've got a really good price. You should just press on. And I'm like, no. Like,
the other 3 walls are great.
Yeah.
You'll be fine.
There's these guys being like, have you tried buying a pre-built house? And I was like, oh, they're like very funny. And yeah, in the end, like the guy selling apparently turned around and was like, I don't know what the holdup is. I was like, I'm tearing my hair out at this point. Like, I need to just walk away. Like, why am I not walking away at this point? And he was like, I tell you what, I can touch up some of the carpet. And I was like, oh my God.
And I'll throw in a lollipop too. It's going to be great.
So, yeah.
So how many offers have you pulled in your 20 years?
What often happens is diligence, right? In the same manner you found a crack in the wall. Like, we put an offer out and, think about the incentive. Their incentives tell us the best thing about, the place or the business. And oftentimes, especially if there's bankers involved who job is only to get the highest price and have 0 consequences when the thing closes, you can see what happens with those incentives. You have to go in, and our job is to really just verify, is that business worth what we kind of had as the offer. And that's where the diligence is really important. And a lot of times it doesn't stack up, because it's, I've uncovered fraud in the past. I've uncovered, lots of different relationships. Sometimes we've had all types of different, issues when you've managed or looked at hundreds of businesses that you never would expect from the first bid. But in many ways, I use the house analogy when I describe what I do to my parents or some other people that still don't understand what I do.
Well, now you've got another one.
Yeah. It's a diligence finding. We buy a house, we try to improve it. We usually use debt or, as a mortgage or leverage. We try to improve the neighborhood. paint it up a little bit. That's our value add.
Yeah.
Add new windows, add an extension.
But yeah, I think, asking more into the music investment industry, like, again, shout out to Chiron. It was really interesting for me hearing why sport for them was such an attractive asset investment class. And for you, that's music. And so I just would like to delve into this a bit more of why music now and where you see it going, and why you like to invest or why you choose to invest in music.
Look, I think there's a couple things. At macro level, I explained a bit earlier, I think music's now at a point where it is more stable, has some growth behind it, although you can argue the last 4 or 5 years are better than the next 4 or 5. But I see many parallels of what's happening in the music industry that we saw happen in, it could be healthcare, where it's a really complex ecosystem and payers and payments, or we're involved with Verifone, which is a big payment network and ecosystem that we have to build something scalable around and create it into more of a service rather than one-time payment, or the same business scaling issues we see with founders and other software and media and production sides. And so to me, the why music is more actually seeing that it's an industry that's so complicated and backwards that not many people understand it to the depth. And I believe fundamentally that technology will ultimately be an enabler to unlock a lot of this, whether it's distribution to, digital is now more than 50% of the music industry's revenues, when, it obviously was a lot less prior. I believe fundamentally that the IP and the artist are the ones that should win, because technology can empower the power back to them. For the last couple of decades, it's been all really driven by some of the large forces, whether it's the music majors who own a lot of the rights and own all the financing around it, or the big platforms who are the ones ultimately monetizing it, and everyone in the middle kind of got squeezed, which was including the artist. But I think as there are more options, as it's easier to make music, as there's more transparency, which has really been bad in music. Technology will enable that and drive that value back to those artists and or the IP owners if they have it. So that's been to me, there's like small pockets of things. Like, I'm not trying to go create the next Universal, but I see a lot of areas that things are under monetized. Like, we helped consolidate the sheet music market. Like, who would have thought? We're helped back one of the founders there to on the digital side, go and acquire the biggest paper-based side, and now we're probably the majority of that market and hundreds of millions of revenue, and now can innovate and create new learning with AI opportunities and kind of grow that industry a lot more. We did it I'm looking at it in the business, the B2B music space. Like, people don't think about it, but the music played at McDonald's needs to have a different licensing than or your pub needs to actually pay different licensing, just like they do for sports. They can't play the normal Sky. They actually should be paying for, they can't play Spotify. They should be paying for a commercial license. And there's billions lost for the music industry and kind of the piracy of those commercial things. But to me, it's finding those micro opportunities that actually can create big businesses. I don't believe every business needs to be a billion, but it's more about when you can own a segment and have really relative market share is what we value. It's like, how big are you versus your next competitor? And that's where power comes from, and that's where profits usually accrue to. There's been some studies that show relative market share versus profitability has a high correlation. And in music, there's some interesting opportunities to kind of create that with technology as the enabler. We try to build businesses that have a sustainable competitive advantage and high market share. Because you're in a world, at least in music, where there's 3 rights owners that own half the market.
Yeah.
There's Apple, YouTube, and Spotify that own over half the market. So to play in the middle, you can look at Porter's 5 forces of your business school class, and it says supplier power and purchasing power. Like, you're stuck. So you need to have your own moat around you, so that you don't get pulled away in those different forces. Okay. And I think that's at least where I try to focus, where you can build that, and it's either things feeding it or around it, or enabling those sides.
Going back a stage just to the sort of wider journey that the music industry's been on, it seems that you've had this dematerialization on the consumer side. So they've reaped a lot of benefits, as you said before. It went, from buying vinyls to then 99p songs, to getting songs basically for free or on subscription. And now it seems there's almost similar on the like producer or like the songwriter side, where there's more power and I don't know if dematerialization or consolidation, but is it fair to say that the consumer side's reaped a lot of the rewards, and now you said it's the artist that's going to benefit?
I hope so. And an ironic fact is, like, we've gone back to the future where I think vinyl sales last year were the highest they've ever been, because COVID became something. But I heard some fact that like almost half of the records or vinyls sold have never been played. They just become collector's items and for the artwork. But I think to your point, like a lot of people lauded the advent of the Spotify streaming platforms as, the music industry is back and growing. At the same time, the number of people that can actually make a living off of it, when you get, maybe it's $1 for 1,000+ streams, like it is not you have to be pretty popular to make a real living. And it still does flow to the largest companies, because now there's, probably 100,000 tracks a day are uploaded. So how do you get discovered in that? And so it's much easier to make music. And now AI music is coming, which just means you can have infinite tracks being created. So for the first time, Spotify and some of the other platforms have started to put some gates, saying, because their gates have been open, anyone can kind of post as long as it's not fraudulent. They started to put some gates that say we won't pay out unless you have at least some critical mass of listeners. And ironically, you should think that, and the independent artists have gained more share over the big companies, but the big companies have also gained power in that they're the ones that have the ability and the resources to differentiate artists or break artists. But all this is changing, and it's because, as we were talking about, TikTok, is now a discovery tool and can break an artist that, used to be only possible when, Warner, had their hands into all the radio stations as the only way to actually discover someone.
This is a bit of a narrative question, and I don't know if it really holds water, but I remember reading something about the average length of the track has got shorter. We all sort of get TikTok brain. Is that something you'd worry about if you're building a catalogue of music of, I'm thinking, I don't know, some of the really old school songs are like 6, 7, 8 minutes.
Stairway to Heaven.
Yeah. Like unbelievable, like well-known song, but is it going to hold weight in a TikTok generation?
I think fundamentally people adjust their behaviors to the systems that reward them. And the system that rewarded the monetization of music has now been a pay per track. And a pay per track. So inevitably, what do? You don't release an album with 8 songs or tracks. You release an album with 20, in the same amount of time. And so it's fundamentally just a reaction to the incentive system that's in place. Have we seen degradation of longer songs? I don't think so. I haven't seen any data to say that, so I don't know one way or the other. But there's definitely an incentive today to do that. But if you put yourself in the shoes of Spotify, or even had conversations with some of the top execs at some of these platforms, and their whole business is cost per content hour, because they're now offering podcasts, or they're offering music, or they're offering audiobooks, which is one of my other businesses or recent investments. And, so there's a misalignment between the track and the hour. So like everything in life, when it swings too far and people start, putting, 58-second tracks in, and that becomes the norm, they're going to switch to probably paying you on, amount of time or cost per hour, which is really what their business model is driven by. And then things will change again, and Stairway to Heaven will be back.
Yeah. Some sort of mean reversion within music trends.
Yeah.
Interestingly, actually, we did some research before we did this, and we found, I think it was something like 90% of podcasts don't get past episode 10, and of those 10 percent that do, 90% don't make it past episode 30 or something. So I don't know if that's really.
So we just got to hit 30, and we'll be off to the races.
We'll be in the
Where
top
are you now?
1%.
What's this? We've had a few retakes.
This is episode 6.
You're 60% to your first failure point.
One thing we touched on, obviously, a few times is AI. Seems to be disrupting almost every industry at breakneck pace. Is it something that keeps you up at night, or is it something that you view as an opportunity?
Yes.
Yes to both.
Look, I think your head is in the sand if you're not if you're involved in technology and not kind of paying attention to AI right now. I think it is something we are and have to be taking seriously. I think AI, though, is 2 letters, but it's a really big concept. And I've personally gone through different waves of, is everyone overreacting? And if you look at human psychology, we, as a society, go through waves of infatuation, or, we were talking about blockchain and the break, or the like, and they've had their own hype cycles. I think the AI, it's real, right? I've seen a lot of it in music. I've seen a lot of it with our companies. We are taking steps to both offensively and defensively kind of consider AI, where essentially we brought together all of our CTOs and essentially did a summit and kind of actually brought in many experts in the AI field and did free trials, kind of forced all of our teams to say, how can you use AI in your business to become more efficient? And I think the first wave of AI, I think, will be beneficial to private equity in our businesses. What I would say is I think the first wave of it is really creating efficiency. So it's how do we take processes that are manual or process-based and make them much more efficient by having the right data and essentially training the models. So, I mean, coding is a very easy example where we've essentially asked or strongly encouraged or yelled to our teams to start using Copilot, or a derivation from Microsoft. So developers automatically getting 30-40% more efficient because the AI is writing it for them or checking it for them. And often what you're doing in coding is doing something that's been done before, or taking different pieces and putting it together. So that's like a no-brainer. We used to save 30 or 40% in development. We'd have to take all the people and move them to India. And, we saved 30-40% until their wages went up 20% a year. And, you lost some of that, and you lose the efficiency of, having to manage the time zone. So this can create that level of savings for one of our biggest costs. Customer service, like everybody refers to the Klarna example of them cutting customer service costs by a significant amount. I thought it was 20, 30, 40%, I don't remember, but also increasing the satisfaction. Why can't, we do that? I have a lot of our companies now. One of our companies does big advertising sales, very complicated RFPs, and they have their customers like NBC or Fox have literally hundreds of people just taking these RFPs, keying them into their system so that they can kind of learn how to do it and then responding back. And lo and behold, you can kind of take the RFPs, we'll put them into a chat GPT or other LLM, and we'll automatically populate it in there. And lo and behold, there's actually less typo errors and it's much more efficient, and we've created a lot of value, and it took us a month to develop. So I think that, we're spending a lot of time on it and the resources, and I think we spend time worrying. I think the next 4 to 5 years, the larger or incumbent companies, if they're agile at it, I think can be the beneficiaries. I think the question is longer term, are they going to be disintermediated by, totally new companies starting with a different cost paradigm or a holistically different way of approaching a problem that's driven by AI? Because now instead of 100 people, you can build it from the ground up with 10 and be just as efficient, or frankly, a better product. But then the whole thing is going to be, again, if you have relative market share, if you're the market leader, if you have all the customers already, if you got it integrated, if you got your own data, it's going to be hard to upseat you. If you're a consumer app or doing advertising or something else, watch out.
I would have thought the modeling side would have been one area that AI could help, because obviously accountancy is sort of defined by a set of rules.
Mm-hmm.
And ultimately, there's only so many places you could, save money from marketing, or,
Mm-hmm.
Maybe you got an underfunded pension, you need to put some money there. Where do you take it from? So I would think that's quite an easy optimization problem, but it seems relatively safe for now.
Yeah. And I think Josh was telling me about one of his business ideas to do a paddle thing at one point. He's like, I haven't had time to do a model or business plan or anything else, and I just put it into ChatGPT and said, build me a paddle model for southeast of England and thing, and told him I did it.
He
and
just
sent
put
it to
me to
him.
shame in 5 minutes.
So I think in the basics of that stuff, like, I can do it. I even sometimes use it like, here's a semiconductor process, a company that never really heard about or I've looked at, and I'll use it to get smart on the industry. When it goes to then model that semiconductor capital equipment company for me, like, that can't easily be replaced, because AI is only an output of some stuff that has to have the input. And the input in many cases for us in modeling is proprietary information on how the business actually works, right? It's getting access under NDA to its financials, it's understanding like what are the real drivers in the business. It's kind of building all that into the system. So, unless you get access to that stuff, you could maybe, make the system a little bit more templated or easier, but the secret sauce is not in the exact Excel. It's more in getting the information that's private and not publicly available. That's why it's private equity, and pulling that together in a manner that's creating judgment. So I'm not afraid of losing our jobs. I think there are maybe some of the analyst or research elements of the jobs that should become much easier over time. But if you're looking for a job in investing, I think judgment is still something that's not there. But at the end of the day, also analytics, can trump judgment in many respects in investing as well. But we have Betterment as one of our, investments. It's not really totally AI driven today, but it's a robo advisor that is doing it at a fraction of the cost and does the automatic tax harvesting and 401k, and it's fundamentally a better outcome.
Just writing fuck in my notebook.
Yeah.
So you've had, a pretty phenomenal career. A lot has gone right for you. Was there anything looking back that you might have liked to have tried, or maybe, gone on your own venture? Or have you been pretty happy with how everything's turned out and where it's headed?
I feel fortunate and been lucky, so I can say that. I've had a few junctures, over the years where I was trying to decide to be entrepreneurial or stay. And I think I never expected to join a firm and still be there, 20 years later. I expected to be there for like 2 years if they would have me. But the benefit of the industry and the place is that it is a reinventing, profession, right? I, for a while spent a lot of time in telematics in 08, like vehicle tracking, and who would have thought that was interesting, or, on a thesis around that being more software recurring revenues, and everybody saw them as like boxes in cars and they were crappy businesses, and luckily it proved out to be more right in the long term. And then I liked mobile for a while, and that was great until I made a disaster of an investment and lost, almost $100 million by doing something, getting the macro maybe right and getting a lot of and some of the macro wrong, and screwing up a lot of the operations of it. Maybe I wish I didn't do that, but also learned a ton, and at least FP was supportive in helping with that. And I did a lot of investments in Israel and kind of across Europe, and spent time in the music in the last 5-6 years. And so in many ways I feel like I've had many careers, even while being at the same place, and that's what's kept it interesting. exciting. Every now and then, do I wonder, the what if? Of course, right? And yeah, I think it's also a tough industry to find the balance at times of work and life, and how do you make it work with a family. But I would say, you know, um, I found out that I liked this job when my mother unfortunately got diagnosed with a terminal brain cancer a number of years ago, and so I said life's too short, and I moved back to Virginia, where I'm from, and spent kind of 6 months there. And FP was very supportive,
That's good.
and
Yeah, amazing.
but I also got bored pretty quickly, and so I found myself going to like some conference for the regional Roanoke Valley Technology Company conference or something, and found some guy that had won the Small Business of the Year in Virginia, and took him out to lunch and started talking to him. And it was an ed tech software business, and ended up pulling together some friends and family, and we invested in it, and I joined his board, and we built the company and management team up, and maybe I added value. But the company grew like 4x, and we ended up selling it to one of our my competitive private equity firms, and
Amazing.
put a clause in there that they had to increase the number of employees in my hometown as like part of the conditions of the sale. Which they abided by, thankfully. And
wow, really cool.
And the founder, he wrote a book about it. And I realized in that journey that, I'm fortunate to do something that I love and I would do, even if it didn't come with all the extra, benefits around it. And so I think to me, it's always been a journey about having to find the balance of that, and how much you're doing, and all the extra overhead that comes from it being, part of the firm.
Very interesting.
Matt, I was gonna say, I know you're still relatively young, but have you given any thought to life after PE?
ITF tour.
Yeah, sure.
The senior tour.
Yeah, as a ball boy. I have given thought to it. I think it's it's our job to always look ahead, right? And I've had some things in the family happen that make you think about life and otherwise. And for me, I think back to that story about I think I always and found a passion in kind of supporting businesses, and I found hopefully I'm decent at helping make things happen that people can't think they can do themselves. And whether that's, and I like doing things where you do it once and you can have multiple effects.
Yep.
So that's why I like technology. You actually build a product once and then you can sell it many times. It's a great business model. It's not like Tesla where you got to build every car.
Yeah.
With software or something else, or even a music track, you can sell it many times. So that means if you can get the system right, if you can get the people right, you can get the processes right, you can really scale something very efficiently. So I think I've come, if my wife will let me, to do that. She probably wants me to do that for the rest of her life and not, just bug her. The question for the rest of life is, who do you do it for and what terms and what time? And so for me, I think my passions are around, kind of probably three things. I think one, I have really enjoyed, and I spent many years looking for a passion in my own job and otherwise. I went to business school jealous of everybody that was like really good at healthcare and loved that, or media, or, being a tennis player. And I was like, what's my passion? And I came away with it thinking cheesily as maybe like solving problems. I like the act of like figuring things out. But I've enjoyed the music side, recently, where it's felt like it's matching that solving problems with a unique set of something that, I enjoy. So I think I will do that in the future. Nature, conservation, climate's where I spend a lot of my philanthropy and time, and, started to find some entrepreneurs or invest behind some people there a little bit earlier stage. And then at the end of the day, life's about like, family and relationships and enjoying. And so I hope to create time for that also in the next venture, so I can find a balance of my long laundry list of I said I was going to build a tree house. I have a Jeep in the driveway that needs a fuel pump. That was my goal this week that I don't know if I'm going to get to. And there's a long laundry list thereafter.
And then I wanted to ask you, so you're quite a good tennis player, but how has tennis, would you say, is quite an important tool in the business world?
I've just started to. I took a long hiatus from tennis.
Yeah.
I probably didn't play tennis for almost really 20 years. So I would say, yes, I wouldn't be sitting here if I didn't play tennis. That's a good thing or a bad thing. But hopefully a good thing.
Yeah.
And I think any sport or kind of competition or commonality should be, right? I think that a lot of people say separate business and life and otherwise. I think, if you have a job you love, you end up doing it all the time, is the reality. And that's the one thing in our job is I say it to other people who join us, it's like there's always more you could do than you have time to do. So your job's to focus on what's actually going to matter and make a difference and focus on that. And then you have to draw the line at some point. So to me, the way you can do a little bit of both is you mix business and pleasure.
Yeah.
And so, I started to do that more and enjoy it. And I think tennis is a sport where, been able to do that a little bit and hope to more. And, if it's ping pong, I'll try that too. But I can't do rugby. So, but I went to, flag football. I used to play all the time in the UK and was my kind of social group of people. And I did investment that or two through that group. And,
Very quickly to round off, I suppose we couldn't really leave without asking you for a book recommendation, bearing in mind
the
we're in a library, yeah.
In the library?
And a vinyl recommendation, perhaps.
Vinyl. Well, I think book, I'd probably say my favorite book is Siddhartha. I don't think I have it up here, but my father gave it to me when I guess I graduated high school, and more about, at least if we're talking about life afterwards and philosophy. If you want business, I'd say the most recent good one is Amped Up by Frank Slootman, who built some of the most successful tech businesses. We just had him speak at our kind of conference where we brought all of our executives together, and it's impressive on how you build culture and operational excellence.
Well, Matt, thank you so much for your time, and thank you everyone for listening. I found this really insightful. Thank you so much for hosting. It's been amazing. Listen, if you enjoyed the content, then please like and subscribe. Josh and I and Ken will be here every week delivering more content like this. Thank you.
Thank you.